that as a school and as a university, we are hosting this public lecture by Governor Lesetja Kganyago. I'd like to thank you for taking time out of your day, a precious part of the day, the morning, to come and grace this event with us. The theme of today's public lecture is monetary policy, growth and jobs in South Africa. I'm going to outline the proceedings and then we will have our Vice Chancellor and Principal, Professor Zebulon Vilakazi, to introduce the Governor and to make a few remarks. After he has done so, he will call the Governor up on the stage to deliver his public lecture, and then we will take 3 minutes on a dialogue on his speech, and then we'll open up for discussion. I'd also like to welcome those who are joining us online. Please feel welcome and do send us your questions and comments on the chat, and we will be picking up on those. Without further ado, I'd like to call the Vice Chancellor and Principal of the University of Witwatersrand, Professor Vilakazi, Zebulon Vilakazi. Thank you.
Thank you. Director of this very important school of government. A topic of serious importance given where we are as a country. I hope you can hear me at the back. Governor Lesetja Kganyago, distinguished guests, members of the academic community, participants who are joining us online, ladies and gentlemen. As Vice Chancellor and Principal of this university, which, as you all know, turns 100 this year and has played a key role in the development of this city, this country, and by extension, this province, indeed the world. I'd like to welcome you to the public lecture given by the esteemed Governor, one of the consummate civil servants I know since I joined the public space myself as well, more of whom we'll hear later. My task is but to introduce Governor Kganyago. The theme of your lecture is timely in that it relates to the major economic challenges of our time, given the global situation we find ourselves in. Indeed, there are no easy answers. And I take an extract from one of the intellectuals of whose quotation is very apt, given where we are. Our democracy, indeed, global democracies are fragile. We have very few strong institutions. It was in this very context that the last 10 years of what we went through as a country, or rather 10 years prior, allowed to successfully target key institutions precisely to undermine the democratic ideals outlined in our constitution. Our institutions are the antibodies that we be the protector against this corrosion and cancer. We are fortunate, notwithstanding all of this, that we have some of the institutions that have become the beacons of light and hope. Institutions that see beyond the cloud and the dust, but with laser precision focused on the matters at hand. BET and the South African Reserve Bank, I'll say that BET, I'm proud to say, is one of those independent institutions that speak to the power and seek light from the noise. As we celebrate our centenary, as I mentioned earlier, it is important for us to acknowledge other such centers of excellence beyond just the academy in our society. The South African Reserve Bank has been the epitome of good governance and fair policies which are much aligned to our constitution. Given the fact that the world has just withstood a global pandemic, the severe lockdowns in China at the beginning of 2020, which have had a disruptive on livelihoods and lives, affected the global supply chain and created demand shock. The recent situation in Russia, the invasion of Ukraine, has triggered spikes in energy and food prices, leading to central banks around the world tightening monetary policy to stabilize prices and defend the integrity of currencies. These geopolitical events and their economic consequences do not seem transient. They suggest that the world is going through an inflection point that you've never witnessed before World War II, 1939, the invasion of Poland by Germany. And leading economists such as Nouriel Roubini note, I quote, unquote, "We are facing a regime change from a period of relative stability, the pattern with post-war years, into a period of severe instability, conflict, and chaos." These are the cold realities that we as leaders need to face, confront. As leaders, we need to tackle them. You've seen what happened in 1929, the Great Depression, which followed the 1929 market crash, 1930 depression, which gave rise to the Nazis and other forms of fascism in Europe. And the risk, therefore, means that we are interdependent as the world economy. In these times, Governor, we need courage, which comes from the French means from the heart, courage. We must have heart to tackle this big problem and not be frightened by populism. Our country is constrained by extended periods of long growth, rising unemployment, especially among the youth. As you all know, numbers speak about a projected GDP of 1.6%, which for a development economy is near disastrous. Just before I hand over to Professor Dr. Kganyago, I'd like to say a few words about a quotation I got from Gustave Le Bon, whose book I read this week. He talks about types of psychology. Gustave Le Bon was an early 20th century French psychologist of the school of Jung, and he says, crowd psychology acts like a hypnotic, and the individual finds himself in the hands of the hypnotizer. The activity of the brain being paralyzed in case of the hypnotized subject, the latter becomes a slave to the unconscious activities of his spinal cord, which the hypnotizer directs at will. The conscious person has therefore vanished. All the discernment and reason are gone. The feelings and thoughts are bent by the direction determined by the hypnotizer, aka the populace. That therefore you get caught into this mass hysteria. That the masses in that collective where people are caught in that mass hysteria don't thirst for the truth. They thirst for sweet and simple solutions. They turn aside from evidence that is not into their taste, preferring to deify error, make error some kind of a bait and a truth. The error seduce them to whoever can supply them with illusions that their master can easily give to them. So to attempt to destroy those illusions is seen as an act of heresy. So being a governor of the Reserve Bank, your job is not an easy one, to give a bitter pill and dispel those illusions. Over to you, Governor.
Good morning, and thank you very much, Professor Vilagazi, Professor Zobo, and all professors observed. And thank you very much for the invite. The last time we this similar lecture, we were under complete lockdown, couldn't come and do it from here, and we had the problem that Professor Zobo got load shed, and he was presiding, and emergency had to be created. Somebody else had to take over. I don't even know whether they had the script, and I think it was Professor Habib who decided to take over at that time. By the time we came back, so we decided that we will do it physically. So good morning to you all, ladies and gentlemen. As I was said, I'm going to talk about monetary policy, growth, and jobs. Central banks as institutions are important long-standing expressions of a universal need for stability in social and economic affairs. Their goals center on achieving some definition of price stability, and in more recent decades, their methods have fixed primarily on inflation targeting. Where they directly target inflation, the primary tool of central bank is the policy rate, normally defined as a very short-term or overnight borrowing rate. At this rate, banks can borrow from the central bank to address overnight needs for liquidity, and this marginal borrowing rate sets the basis for all other lending rates in the economy. A secondary policy goal is a blend of communications about current economic conditions and the policy rate level. A third encompasses the requirements and flexibility of the policy framework, the target itself, and how it is measured. In more recent years, and under the impact of deflationary conditions, a few advanced economies, central banks have adopted their approaches with secondary targets, such as inflation averages over time and unemployment rates. Today, I want to spend some time unpacking why it is useful for the South African Reserve Bank and most emerging market economies generally to target inflation, and why achieving that goal ensures that monetary policy includes economic growth and job creation. I will look at recent changes in policy targets for the moment, before returning to current conditions and the relevance of jobs and growth targets for monetary policy. It is useful to start with the global economic shocks of the past 15 years and their monetary policy implications. While the global financial crisis and the COVID-19 pandemic had different origins, the economic policy responses to them were similar. Advanced economies reacted to both by dropping interest rates as far as possible and using quantitative easing. During the global financial crisis, quantitative easing programs kept asset prices of various kinds higher than they would otherwise have been, preventing asset price deflation from causing even worse economic outcomes. And during the pandemic, quantitative easing additionally supported spending, as mobility and many face-to-face economic transactions were curtailed while also protecting financial institutions. Job creation was also a major focus for major central banks, and job creation became a measure of their policy effectiveness. More liquidity would help keep interest rates low, enabling firms to keep paying wages and to restart the economy. What impact have these efforts made on policy frameworks? Certainly, where countries face collapsing growth and weaker inflation together, they could all move policy in the same direction. However, when the global financial crisis ended and the pandemic ended, not all faced the same policy trade-offs. The global financial crisis itself ushered in an extended period of ongoing quantitative easing and low rates, but this was not true for most emerging market economies. The end of the pandemic has been different. It has thrown us all back into a pre-Great Moderation world in which inflation is super sensitive to supply and demand shocks. In particular, and with the benefit of hindsight, the current global inflation finds much of its origin in a too aggressive use of quantitative easing and in negative real rates as the pandemic started to wind down and economic activity rose. As in emerging economies post global financial crisis, many countries now, post-pandemic, find their output gaps to be badly measured and giving off incorrect signals about their policy stance. And if the current surge in global inflation wanes, some advanced economies may very well return to lower inflation for structural and demographic reasons. These central banks may retain other metrics in their policy frameworks, such as economic growth rate or the prices of specific assets, for example, house prices in New Zealand, or in the case of the United States, employment levels. But it is highly unlikely that emerging market economies will decide to change their policy framework. Many had reverted to much higher inflation even before the pandemic eased, while others, like South Africa, are now caught up in broader inflation. In a context of normal conditions, the standard monetary policy approaches made as much of a positive impact on economic growth and jobs as they can. However, the real solutions to faster growth and job creation lie in other policy domains. So, why the difference between advanced and emerging economies? And why might the rules governing objectives differ somewhat? The answer has to do with pure economic theory, actual experience, and with the different economic conditions, both cyclical and structural, faced by different central banks. To begin, it should be clear that for quite some time, essentially since the early 2000s, central banks of advanced economies have faced stubbornly low inflation despite low interest rates for a range of structural reasons related primarily to demographics and high savings. So, when they took an accommodative stance to raise growth and employment levels during the great moderation of the 2000s and the period into the pandemic, inflation still remained modest. As the pandemic hit, because inflation remained low, there was as yet no contradiction between the inflation target and boosting growth. Policy expansion could help get people who had dropped out of the labor market back in. Job creation was efficient. Expansionary stances worked well with strategies that lowered the cost to firms of retaining people in their jobs. In South Africa's case, the pandemic also facilitated expansionary policy precisely because inflation had trended lower from 2017. This allowed us to lower policy rates sharply in 2020 to confront the shorter-term damage done to the economy. The repurchase rate averaged 6.7% between 2017 and early 2000 before dropping to 3.5% in March, April of that year. As in advanced economies, our expansion did little to immediately bring back jobs. Many were lost as lockdowns were extended, while some new ones were created in various services linked to the shift in consumption patterns. Expansion did support the recovery of both pre-pandemic spending patterns and many of the jobs associated with them. Of course, there is also much further to go as some sectors remain constrained. The open question is whether sustained expansion in an environment of high debt levels and rising inflation could live up to the hope of those that argue for a jobs mandate for monetary policy. The short answer is no. But let me explain why. Our basic problem is that while growth creates jobs, inflation does not. Not only does this fatally challenge the belief many hold in the existence of a usable Phillips curve, it also limits what macroeconomic policy can achieve in terms of job creation. As we have noted many times in the past, the solutions to our unemployment problem lie well outside the realm of monetary policy. And in fact, the failure to employ those solutions directly limits the positive contribution monetary policy can play. Let's look at what the historical data tell us about Phillips curves. We see two correlations. One is that as inflation rises, unemployment rates rise. This characterizes the late 1990s and into the latter half of 2003. In 2002, 2003, for example, inflation reached double digits in South Africa, even while employment was falling, when unemployment reached 30%. From about 2003 to 2007, however, we see another correlation where inflation falls and employment rises. After the global financial crisis, from about 2011 to 2019, we see something different. Inflation first came off the highs of the global financial crisis and then accelerated back up towards around 6%. There was some initial recovery in jobs, but as time went on, the acceleration was increasingly located in the public sector rather than in the private sector. Economic growth weakened quite sharply from 2013 to 2015, and then more gradually slowed through to the pandemic. From 2017 onwards, inflation decelerated and so did job creation. The global financial crisis and the pandemic were relatively clear instances where policy could respond in textbook ways to support the economy and see through inflation shocks. Before and after these crises, we see more transparently the longer-term relationship between inflation and job creation. Firstly, inflation does not create jobs. And second, on balance, expansionary policy prompts more inflation than growth or jobs. This tells us that South Africa's Phillips curve is near vertical at a low rate of positive economic growth. This is strong evidence that the basic job creation mechanism is being impeded by things other than aggregate demand. This adverse relationship between policy expansion and inflation kicks in when employment levels rise above what is called the non-accelerating inflation rate of unemployment, NAIRU as it is called. Evidence for South Africa shows that this happens when unemployment rate is still very high. This is exacerbated by level changes in the NAIRU caused by structural impediments to job creation. For instance, load shedding or higher transport costs indirectly increase the cost of creating jobs and push up the NAIRU. A range of long-standing factors contribute to our very high NAIRU. Perhaps the most important of these is where people live and the cost of supplying their labor as well as the skills they have compared to their cost. Regulatory costs of our economy also feature in various ways, including housing where businesses can ply their trade and compliance, which is a much larger burden for small and medium-sized businesses compared to that of larger firms. Part of the difficulty is that we have done little to make it easier for less skilled workers to find jobs or make it less costly to employ them. Another part of the falling job creation machine is simply weaker real economic growth compared to the 2000s when job creation was relatively strong. This should not, however, lead us down the path of grasping at another seemingly easy answer. Higher inflation will not get us higher sustainable growth. Instead, inflation undermines short-run growth by increasing interest rates on borrowing, affecting consumers buying on credit, and business owners who want to use credit to invest. Higher interest costs reduce short-run cash flow, reducing all future consumption spending. While surprise inflation reduces the real value of existing stock of debt owed, the trade-off is lower economic growth in subsequent years. The short-run benefit of a surprise lower interest rate is transformed by higher inflation into a long-run cost to growth. When inflation is higher than that of our trading partners, we suffer a continuous loss of competitiveness. Higher inflation overall also generally means higher inflation for poorer and less skilled South Africans than the wealthy. This increases inequality further and worsens the already low standard of living for those households, making them costlier to employ. For a few years before the global financial crisis in 2008, the relationship between growth and employment was better. If economic activity grew by 1%, employment grew by 0.62%. Let me repeat. If economic activity grew by 1%, employment grew by around 0.62%. Yet, there had been a narrative that said you could have, or we had as South Africa, jobless growth. The reason we are not having jobs now is precisely because we are not growing. So since that period leading to 2008 and up to 2018, each percentage point improvement in growth now only gives us 0.3% more jobs. Our low employment problem overlaps entirely with our low growth. In this context, the best a central bank can do is stabilize unemployment at a rate consistent with price stability. If a central bank attempts to get unemployment below the Naira, the result will be larger quantities of inflation, but only small and temporary quantities of jobs as the supply curve becomes more critical. The same is true for economic growth. Assuming that most of our unemployment problem is structural, are we at least sure that the residual cyclical unemployment is being reduced by monetary policy? Is a dual mandate better at addressing these cyclical drivers? At the South African Reserve Bank, we use an alternative measure of economic activity to the Naira for understanding where the economy is relative to its tipping point into more inflation or into deflation. This is the output gap, which measures the distance between the possible or potential growth rate of the economy and the actual or realized rate of growth. Think of the potential growth rate as the speed limit on the road. A skilled driver might be able to drive faster than the speed limit, but there are consequences. You could face death or even jail for running faster than the speed limit. If an economy runs faster than its potential growth, the consequences are higher inflation and subsequently even lower growth. Similar to the United States Federal Reserve, we use what is called a Taylor rule to help tell us what the interest rate level should be given the output gap and the distance between the inflation rate we want and where it currently is. The Taylor rule tells us that we should set an interest rate that includes how quickly or slowly the economy is growing compared to the speed at which it could be growing. If the output gap is a good representative measure of the cyclical unemployment rate, then we are fully covered. The monetary policy equation we use to get to the interest rate includes, at best we can, the relationship between growth rate and employment. If we look at how the Fed operates, we can take further comfort in our own framework. The Fed has an inflation target of 2%, averaged over time. This averaging introduces some flexibility, but flexibility to not respond to inflation shocks that are temporary, just as in our flexible inflation targeting framework. But the Fed framework does not say that when unemployment rate rises, it will aim for a higher inflation rate. In other ways, the dual mandate recognizes that in the long run, the highest cyclical employment rate is consistent with low inflation. In the policy debate at present in the US, there may be a rise in cyclical unemployment to get inflation back down and to achieve a lower sustainable unemployment rate. We also need to be cautious in our current circumstances. With surging inflation in advanced economies, it is likely that the adjusted policy frameworks of recent times will shift back to simpler and clearer formulations. There are three takeaways from this discussion that stand out. One is that inflation targeting central banks also consider real variables such as growth and unemployment when they make monetary policy decisions. The South African Reserve Bank is no exception. Second, that central banks don't drop targeting inflation even if they have an employment mandate. It simply means they respect the Naira and discuss more directly its level and what can happen to inflation when the speed limit implied by it is exceeded. The third takeaway is that despite some policy innovation in recent times, in some advanced economies, these may well be scaled back to simpler frameworks. Finally, we need to recognize, for the sake of solving our low employment problem and to keep monetary policy focused on the right things, that many issues sharply limit the transmission from policy to job creation outcomes. One is the job intensity of growth, which we discussed. Another is the supply of skills that are coming into the market and their cost. Some might argue that in that case, it means that monetary policy should be pushed much further and harder to get the expected growth of jobs. Unfortunately, with inefficiencies and constraints, when inefficiencies and constraints exist, pushing harder on monetary policy is like pushing hard on the accelerator on a curvy, icy road over a mountain pass. At present, many central banks are speeding on that ice, with global inflation sharply higher and persistent. Even our own relatively benign recent inflation experience has become much more challenging very quickly. We have seen now that having two targets certainly does not mean double the benefit. Instead, it means that there are times and certain conditions when one policy tool helps to achieve both. It also means that under other conditions, one tool cannot achieve both. And much of the world has now entered this territory, a policy dilemma. When policy becomes overloaded with too many and contradictory objectives, then negative outcomes are more likely. As inflation rises and growth slows down, a central bank that fails to respond to the rising prices will face the prospect of compounding inflationary shocks, currencies depreciate, and investment fails. So, where in all of this does South Africa find itself? We have not reached the end of our policy rate space. We do not have stubbornly low or close to zero inflation. We are experiencing high inflation that has been rising for the best part of the year. Inflation expectations, for the most part, are proving to be more responsive to the current inflation outcomes than we would like, and less anchored around the midpoint of our time. If the expectations that firms and households hold for future inflation stray from the inflation target, then higher nominal wages and consumer prices are likely to emerge. In other words, once inflation expectations rise, they become a self-fulfilling prophecy, and the central bank has a more difficult and longer-term problem. A more expansionary policy stance runs that risk by enabling first-round inflation to embed into second-round inflation. Put simply, you see prices rise, and because you see prices rise, you ask for higher wages, and because you are asking for higher wages, the firm raises its prices again, and then the court in that cycle. Central bank's job is to break those cycles. This implies that we need to continue the normalization of interest rates, moving them closer to the level that is consistent with more stable inflation rates and sustainable economic growth. At present, our repo rate is at 6.25%, still below long-term levels, but rising to a more sustainable long-term level that is consistent with inflation stabilizing at 4.5%. So let me conclude and look forward to the engagements. As we have discussed today, neither growth nor high inflation lead directly to job creation in our economy. Much of our employment challenge lies in encouraging the return of economic activity in sectors that have been hardest hit by the pandemic. And we will also need to recognize that more jobs may be permanently lost as firms do things differently and as consumption patterns shift. Other jobs will be created, and permanently impacting on employment levels requires approaches that have nothing to do with monetary policy. just adding jobs targets will not get us there. And indeed, part of our inflation problem stems from efforts to achieve such targets at a global level. We should be careful not to add to our policy objectives in a way that surely would push us into sharply higher inflation. If these are the primary constraints to job creation defined by the literature, and monetary policy has no impact on them, then the claim that more expansionary policies will solve the unemployment problem is simply an empty promise backed up by little more than ideology and wishful thinking. We have an unemployment problem that needs more credible solutions. Employment and growth are both limited by factors that are beyond the reach of the central bank's toolset. The best chance we have with monetary policy to get faster, more job-rich growth is to maintain our focus on price stability with flexible inflation targeting, a proven framework. This enables the SARC to help maintain a stable environment that is conducive to economic growth, and because credibility is high, for it to create the necessary flexibility to ignore short-term inflation shocks. A credible monetary policy will also keep borrowing costs lower. This is a central benefit to long-term economic growth and job creation. When inflation rises and stays high, investment decisions are distorted towards short-term investments that carry with them short-term jobs. For this reason, low inflation is a sound developmental policy. It encourages firms across the private and public sector to make long-term investment decisions that imply productivity growth over time. This is critical, indeed, a prerequisite for sustainable jobs and income growth. Consumption based on rising debt levels cannot be a sustainable growth and development strategy. Having faced the unique threat of COVID-19 crisis, we confronted that challenge with relatively low stable inflation and policy space. We were able to soften the damage of the crisis with the policy rate while still protecting the value of the rand, and in so doing, we were able to play our part in maintaining macroeconomic stability. Now that the global economy is recovering and inflation in many countries, including our own, is rising, we have learned from experience that we must not be tempted to loosen our grip on inflation or to fall behind our peers as rates are normalized. The consequences will be too costly. And if we are faced with this, we need a conversation with society. Conversation we need with society. That yes, there are trade-offs. Trade-offs must be made. There is no such thing as a free lunch.
Thanks, Governor, for such a packed lecture that explicates on multiple challenges that the world faces, and in particular, the tensions within our own country. I just have a few questions before we open up to the rest of the audience. And you talked about the trade-offs to be made, the fact that we can't have free lunch. Some would wonder whether you can give us some hopes of green shoots anytime soon, if you were able to place a timeline on that, to give us some comfort that the era of rising policy rates will bear green shoots on growth and stabilize employment. When would that period be? It seems that everyone is asking this question, that the central bank governors around the world they don't quite know what the end point is going to be. I'm not sure if you've thought about this. Thanks.
What we saw from the effects of those was that mining companies and mining employees started to pay significantly higher amounts of taxes to the South African Revenue Service. That enabled the Treasury to pay down some of the debt, and as such, debt is picking up at a level lower than what was previously thought. I mean, when we gave the lecture last year, the talk was that debt could exceed 100% of GDP. By the time we got to the budget this year, it was like it will peak at about 80%, 75%, and now it is said that it will peak at 71%. So that basically means that South Africa has been able to rebuild its defenses to be able to face whatever shock that comes up. And it looked like we were getting back to the nice period because growth was rising, and at the time inflation was still contained. Entered the war, and global supply chains were significantly disrupted, and because global supply chains were disrupted and the economies were coming out of the lockdown, inflation was beginning to rise, and it was rising rapidly. For many in the advanced economies, they would not say it, but the truth is that they are playing catch up. Inflation has run way ahead of them, and that is so. When I talked about that policy dilemma, where you are faced with a situation where growth slows down, but inflation is rising, you can't. If you decide that I am going to let inflation go, what's going to happen is that down the line you are going to need even more aggressive policy adjustments to bring down inflation. And when that happens, it comes at a cost to longer term growth. And so that is what we had faced. Now, globally, advanced central banks, economy central banks are increasing interest rates. And because they are increasing interest rates, we are having a repricing of global financial assets. So you are seeing money flowing back into the US as their bond yields rise, but also the growth differentials are still favoring them in the US. So you will see capital flowing back into the US and other advanced economies. Where does that leave South Africa? What it says is that we have got to be rebuilding our defenses. That is what you have seen with the budget policy statement that has come through. Why is it important to rebuild our defenses? It's because globally, capital looks at distinguishing one country to the other. And they are looking at the policy framework, and the countries with the less prudent policy frameworks get punished. And the experience of the past few weeks shows that that punishment is not confined to emerging market economies. If an advanced economy adopts reckless policies, it too gets punished almost instantly, irrespective of whether it has a reserve currency or not. It gets punished. It gets punished instantly. So it's important that we stay the course and make sure that our macroeconomic policy framework is prudent, because we know that prudent macroeconomic policy served South Africa well going into the global financial crisis. We saw it. It led to higher growth. It led to better job creation. And need I say that our macroeconomic policy from 2011 or 12 was not as prudent as it had been in the past. And the results are there to say, for everyone to see, because we couldn't rebound sustainably after the global financial crisis. Part of it being that we didn't rebuild our defenses. It was a very important lesson for South Africa that coming out of this crisis, that we are able to rebuild. You have loaded so many questions. I hope you do not.
Fiscal policies, how dangerous these are. We saw in the UK, I think you were probably, without mentioning the country, referring to their recent troubles. Now, the couple of things. One is that there's an argument to be made that perhaps we should push a little harder on investment-oriented fiscal spend to create an enabling environment or to crowd in the private sector. But also there are social tensions in South Africa, the rising levels of inequality. There are going to be pressures on the expansion of social protection measures very soon, and perhaps paradoxically, the levels of inflation will make the 350 social relief for distress grant insufficient. How do you see us playing these trade-offs, one, to maintain social stability, but also to make a push for investment drive?
The reason I spent so much time talking about how we deal with the challenge of employment and unemployment has to do with the fact that the biggest source of inequality in South Africa is not that there are people who are paid too much and people who are paid too little. It's because we have got people who are paid and people who are paid zero, the unemployed. And that, the unemployed makes our inequality situation even more pronounced. And we can come with all sorts of other social policies to try and deal with this. They are transitory in nature. Long term, we need to get this country working. And I deliberately said we must get this country working because we also need a conversation that says that when people come out of this institution, are they going to be job seekers or are they going to be job creators? And it's a very important conversation for us to have. But let me also be clear about how dangerous you said expansionary fiscal policy can be. Expansionary monetary policy can be as dangerous. But let's be clear. There are times when expansionary fiscal policy and expansionary monetary policy are necessary. And there are times when they become dangerous. When do they become necessary? When you have experienced sudden shocks and you need to temporarily lift a demand, they become useful. What does history tell us? When this economy was pumping,
in the period up to 2008, growing at some stage at like 5.3% per annum. As I had said, for every 1% growth, we were creating 0.4% in jobs, and it was an era where it was common to report that South Africa has created 300, 500,000 jobs. That was the era. And during that period, what was the stance of fiscal and monetary policy? It was contractionary. But we didn't call it contractionary at that time. We called it counter-cyclical. It was acting counter-cyclically, right? So we got into the global financial crisis with policy buffers because the Treasury had even a budget surplus. Inflation was within the target. And so we could respond to the shock. And so it became necessary at the time to embark on expansionary fiscal policy. If my memory serves me well, the government at the time announced an infrastructure spend of 787 billion rand. What happened to the money is a subject of another day, but that was the amount of money that was talked. It was expansionary fiscal policy. And but as we got into after the global financial crisis, it was clear that prices were rising. And at the time, what we was talked was that we needed to come out of the thing. But now the stimulus has got to be temporary. You can't be permanently in a stimulus because remember, you said you are acting counter-cyclically, so it depends on the cycle that you faced. When the pandemic hit us, there was dollar fiscal space. So the Treasury couldn't go aggressive and respond in the aggressive manner that it responded in 2008, 2009. The burden fell on monetary policy. Why? Because monetary policy had the space. Inflation was low, and because inflation was low, we were able to adjust the policy rate, brought the interest rates down very quickly, including calling a meeting over the weekend to get it done. That is what makes monetary policy more than just a science. It also becomes an art that we had to do that. But as inflation rises, you can't expect us to continue to adopt an expansionary monetary policy, because otherwise, should we be hit by another shock, we will not have the space to respond to that. Even with the adjustments in the policy rate as they stand, monetary policy still remains accommodative. Our policy rate is at 6.25%. Our inflation is at 7.5%. So our policy rate is below the inflation rate. So it is still in expansionary territory. Put simply, what we have been doing was not to slam the brakes on the car. What monetary policy simply did was to take the foot off the accelerator. Now, you had talked about infrastructure. The lament of the Minister of Finance last week was that the infrastructure money went unspent. So it's not that the money was not allocated, it was simply not spent. But you see, that was his lament, but I will not question him about it.
You've got to remember, Governor, that our memories are short. We forget good times. Just the last question from my side, and just to get your sense of how the global economy and global governance systems are reconfiguring. And if we remember history, at the end of 1945, Second World War, we had the emergence of the Bretton Woods system. 1960, the 60s, the introduction of I think it was 69, the introduction of the special drawing rights. 1970, oil crisis and the collapse of the gold standard. 1980s, world recession and lost decade for Africa and Latin America. One can go on, and in each of these crises, the global economy is configured differently and global governance institutions take a certain form. Now, fast forward and looking at where we are, we have geopolitical frictions, rising sovereign debt threat for many low-income countries. And it doesn't seem that the shocks, the supply and demand shocks are going to end, especially if we see the bifurcation of global supply chains as tensions between China and the US are also intensifying. What is your prognosis of global governance in future, and where do you place countries like South Africa and broadly the African continent in that redefinition?
Well, not my biggest strength, so I will narrow my response to global institutions of economic governance. And I would like to take this thing back. What in your period you didn't mention the Asian crisis in 1997 that led to eventually the creation of the G20 and the 2001 Argentinian default. So those things. But here comes the thing. You will always have this configuration. But getting into the global financial crisis, developing countries argued for a well-resourced IMF to be able to respond to crises. The advanced economies blocked it. And in the G20 summit in 2009, temporary resources were availed to the IMF. Additional resources were availed to the multilateral development banks, but the IMF was only given temporary resources. And the whole idea was that, oh, this is just a temporary thing and it happens once, I don't know in how many decades. In 2018, I was the chair of the IMFC, the International Monetary and Financial Committee of the IMF. And we had as our agenda the resourcing of the IMF. Again, there was a pushback from the advanced economies. Entered COVID. The only time, I mean, it was like, okay, previously you could argue that countries get in debt distress and the IMF have to step in. Here we are now, the crisis in 2020 was measured in human lives. People were dying. And that is how the IMF eventually got additional resources. Unfortunately, in the manner in which these resources are allocated, they are allocated proportionately. And that meant that the bulk of the resources ended up with the countries that do not need those resources in the first place, okay? And so a mechanism was being designed within the IMF where the special drawing rights could then be reallocated or temporarily to the countries that actually need them and need them the most. Secondly, had been that as we were getting into the crisis, and I'm no epidemiologist, I am no health expert, nothing. As soon as there was any inkling that the vaccines are having prospects, they hoarded them. They hoarded them in the north, right? And prioritized their own thing. The problem is that this virus does not know boundaries and it just keeps on going. And then it was very simple. None of us are safe unless all of us are safe. I'm painting this because the world trade system is also facing a test with countries declaring certain products as strategic. And you said, Prof, it leads to bifurcation. Well, bi, I suppose, means two, but I actually see a multiplicity of this. I don't know if it's trifurcation or what, but I see a multiplicity of this. And then I had learned last month, this very last month, a new term called friendshoring, which says that countries decide that they are now going to trade with their friends, and which then leads to a fragmentation of the world trading system where you had the World Trade Organization as the governing body that would have enabled us to resolve trade disputes and so forth. And it doesn't matter how many economists you put in a room to make the argument, all those beautiful ideas will die at the altar of politics. And what needs to be sorted out is the global political governance. Otherwise, we will not be able to sort out those institutions.
Yeah, that ends on a grim note. Let's take a few questions from the audience and see what you know. Yeah, let's see. I think there's a gentleman over there. If you can also just introduce yourself briefly.
Thank you very much. My name is Muzinkosi. Just a quick question to the governor. I'll first start by making a statement that inflation, as far as I understand inflation is a general increase in prices. Now, when you check South Africa, I just want to know from you, Governor, is this inflation rate that you are giving to us driven by excess demand? Because if it's not, then it means that the instrument is fraudulent. I'll tell you why the instrument becomes fraudulent. If our inflation is not driven by excess demand, it means that now monopolies are taking advantage on the depressed economy by rising prices. I'll give you an example of what I'm talking about. Currently, we are sitting with the situation where a price of 5-liter cooking oil rose by 90%. That can be inflation. But when you do your figures, that becomes added to the basket. 2 weeks back, the Competition Tribunal raided 8 South African insurance companies because of price fixing. Those prices are also included on the same basket. So with that being said, that's why I'm saying, let us get rid of that instrument of inflation targeting, because it's not going to get us anywhere. Second point, Governor, 2020, when you started decreasing the repo rate, our inflation was sitting within your target, because you're saying you're targeting between 3 and 6%. We were sitting at about 3.1, but you had the room to decrease the repo rate. And thank you very much for that. That was a job well done. Some of us, we managed to get into the good housing market, but now you're killing us. Now I can't even afford lunch, because I'm hoping the organizers have organized lunch so that I can have some. It's bad. It's bad, because I do not understand the increase at this point. Because if you were to say to me, this increase is caused by excess demand, then I will come and fight with you directly there in the stage. And it's not. So monopolies are taking advantage of this depressed economy, and they're overpricing. What are you doing about that? There's simply nothing at this point. We know that Bonagele, the guy that heads Competition Tribunal, is sitting with a lot of cases. So there's too much price fixing on the market. Yeah. Last one that I want to give to you without wasting time. When the mass mart came into the South African malls, I'll give you an example of game. So normally in a mall, you'll have 2 supermarkets that are operating. You'll have your Pick and Pay or Checkers. They wanted to kick game out, and the reason being was that game was very cheap. So the same shopping basket that I was paying for at Checkers and Pick and Pay, it was less at game. So this inflation yara nonsense must come to an end, because we cannot tolerate it anymore.
Yeah, sure.
Thank you very much.
Just to maybe add a point to what this gentleman has asked the governor, we've there's some who have also been making a point that the prices have largely been driven by energy prices, which has nothing to do with South Africa and more to do with Europe woes. Maybe if you could shed light on price fixing issues, artificial increases in prices, as well as the flow through of energy prices from Russia-Ukraine war.
Well, Muzi started well and then contradicted himself. You see, he said that the Competition Commission has been raiding people for price fixing. And then he turns around and he says, you are doing nothing about it. The point here is that the Competition Commission had to do that because that is exactly their remit, to deal with market abuse, to deal with price fixing. That is exactly the role of the Competition Commission. And the Competition Commission is not one person. Bonagele, my friend, has served his term. There is a new commissioner there, but that commission is working, and we must allow it to do its job. So there might be market concentration in the South African market does lead to unnecessarily high prices. That means that those must be dealt through appropriate competition policy, and I think the Competition Commission is doing a good job. So I will not venture there. Let's deal with your assertion about the origins of inflation. When you experience a shock, like a fuel price shock and a food price shock, what central bankers do is to not respond to that inflation. We don't. And we actually didn't. What we do is to see whether that shock becomes permanent and respond to the effects, what we call the second round effects of that shock. And in my talk this morning, I talked about how there was a debate among central bankers about whether the shock is transient. And central bankers in April, in Washington, when we were meeting, we were divided into two camps. There was what was called team transitory and team permanent. And team transitory thought that they had it. When we went back now in October, there was no team transitory. We had all become team permanent. Why? Because inflation has moved from being that temporary shock to spread into something else. How do we know that inflation is no longer that temporary shock, that it is more transient? In South Africa, like it's done elsewhere in the world, we take from the inflation basket and remove those two volatile items, being food and energy. We remove them and say, if we remove them, where is inflation? And the reason why throughout 2021, when the other emerging markets, mainly in Latin America, were increasing interest rates, Brazil started increasing interest rates in May last year. If you think we have been aggressive in our interest rates, Brazilian policy rates are at 11.775 at the moment. They started in March last year. And so why didn't South Africa then respond in March like Brazil? The reason we didn't respond in March like Brazil was that when you remove those two volatile items, the inflation that is remaining, what we call core inflation, was contained. And it remained contained throughout the year. And as a result of that, there was no need for monetary policy to increase interest rates. But by the time we got to November, we saw evidence that the increase in prices have moved away from food and fuel, and it was starting to spread itself into other prices. How does it spread itself into other prices? There are a couple of things. The lower deciles of our income earners spend a lot of money on food. And so when inflation goes up and is driven by food prices, for them, the headline inflation means nothing. Their immediate inflation is what they see. Put simply, inflation erodes the buying power of the population. And if the authorities do not step in and contain inflation, we are selling our people short. We have got to deal with inflation. So there is evidence now in our inflation dynamics that showed that core inflation is rising, and actually in our forecast, we expect that core inflation will rise close to just over 5% into the next year, and that actually headline inflation might even be coming down faster than core. The reason, if there are statisticians in the room, are mainly base effects, because these increases that we saw this year, next year you calculate the increase on a higher base, and so the effect comes lower. So inflation has become spread now beyond those headline things. And you say that, well, if it is not from the demand side, do not respond. Well, I used this metaphor. If a snake enters your house, you don't ask the snake, are you from the demand side of the forest, or are you from the supply side of the forest? You have got to manage the fact that the snake is now here. You have got to now manage it. And that is what we face. And the decisions that we are going to make are going to be difficult. There are trade-offs that we make, and that is what we are tasked with.
Sure, tough job, Governor. Let's take two last questions before I read the ones from online, and then we'll allow you, Governor, to close. No, please, we still have time.
But just as a point of clarification, I'm not talking about. No, I'm
Oh, okay.
But point of order again, Chair.
Okay.
This is a place of intellectual discourse. As Russia said, I take exception to that. It's the place of discourse.
All right. So thanks for that. Otherwise, I mean, great points you raised. Couple of people have raised similar points, and I think we don't have sufficient time to explore all of them. But there are serious trade-offs, between. I mean, those who are entering the housing market for the first time are battling to access the housing market, and these are middle classes. But then you also have to think about those at the bottom who are earning very little or with no income, and we have to think about how to stabilize prices. I mean, those are the decisions you have to take, Governor. And let's take this. Let me just see this side. I'll take TK at the back. I know his name because he's my colleague. And then we'll take the gentleman here. And then we'll read from the chat and allow you, Governor, to make your closing statements.
Good morning, and morning, Governor. It's not my voice, I'm very sure. I've got a bit of a more manly voice. I just have just two quick questions. One is, I know you loathe to do predictions, so I'll ask you a historical question. If you maybe could just give us insight as to where do you see the period we're in? Are we in the 1979 period where we had, I think, Paul Volcker come in as a US Fed chair, where it was just high inflation? And if that's the period you think we're in, what lessons can we learn? Because I think for America, I think it went up all the way to 19, the interest rate. So I just wanted, if you could just give us insights into historically, where is your mind and where do you see the current problems we're in? Secondly, Larry Summers speaks about the need to take advantage of the crisis that we're in. And I know it's not necessarily within your portfolio to do, but if you were to take a shot to say, how do you take advantage of this crisis, or how do you give advice to take advantage of this crisis? And lastly, if I may take maybe privileges of being coming from the Wits School of Governance, if you can answer the historical question, answer the question of how do we take advantage, do you think the South African Reserve Bank going forward in a period of uncertainty is dynamic enough to really lead a population in the problems we're facing with new types of instruments, understanding, as you correctly say, that look, what we really are dealing with in South Africa is a question of poverty and unemployment. And does the Reserve Bank really speak to that language, and do we have the right instruments going forward to be able to take advantage and really bring South Africans into a different type of dynamic? So thank you very much.
Yeah, please go ahead.
Thank you for the opportunity. I have two questions. One is there like a minimum number of times and a maximum number of times you as the Reserve Bank can basically intervene in like managing the economy via the interest rates? Because the last few years there's been a number of opportunities or situations where it was warranted that you guys get involved in managing the economy. And I just want to find out like what's that threshold of number of times you guys can intervene in a year, because ESCOM, with the high inflation as well, they are a big contributor to the high standard of living in South Africa right now, and also the international conflict between Ukraine and Russia as well. Then my second question has to do with more about the state-owned bank. Does that make sense to you? And what is the right conditions for a state-owned bank for South Africa to exist?
Okay.
So thanks. Let me also just read the ones from the chat.
Could we,
Okay, no, that's all right.
I've not been taking notes. I'm training my mind to remember things without writing them. So I just want to take.
That's all right.
Let me start with the easier one, because TK's question is very loaded. It was TK, yeah.
Yes.
Yeah. Yes. So let's start with the last one. There isn't a limit of how many times a central bank can take its action. I think the US schedules 8 meetings a year where they deliberate on the policy stance. We schedule 6. But in 2020, we had 7 meetings. And the reason was that in the middle of a crisis, you can't wait for the next meeting. You can call an emergency meeting. And that is exactly what we did. Why did we call an emergency meeting in 2020? Well, we were working on the basis that the country was under lockdown for 21 days. And then, boom, the president announced that the lockdown is extended. And then we decided we can't wait. Let us meet urgently. We normally meet for like 3 days. We met for a maximum of 4 hours that day, and we took a decision. And actually even announced the decision before before the press conference, because once we said we are calling a press conference, people start speculating, why are they calling a press conference? So we announced the decision and then did the press conference. So that is what we would do in the intervention. The last question that you had about the state bank, I think the state, like all the players, has got a right to be involved in activity. And the central bank is a regulator of banks. We license the banks. So if the state wants to have a state bank, it must put in an application like all the others, so that that application of a state bank can take place. Of course, the question that South Africans must ask is what ill is the state bank trying to fix, and whether it would be able to stand. I do know that banking is not cheap. They need a lot of money to spend on IT and the lot. We had previously received an application for a state bank via the post bank. We gave them a temporary license for 12 months until they can sort out certain things. They didn't. That license has lapsed, so they must put on a new application. So it's not our space as the licensing authority to express a view about the viability or otherwise of a bank. So if the application comes and it meets the criteria, we will deal with it according to those criteria.
Sure, thanks. Last set.
Sorry,
TK's questions. Yes. Sorry.
But he said he's asking the questions, but he knows the answer. No, the era. So many of these eras are different. We can learn from each of the previous eras. I don't think that we would be able to characterize this era as like the Volcker era. The Volcker era just dealt with a rise in inflation. Here we are coming out of a pandemic. The last time there was a pandemic like this was 1918 with the Spanish flu, and many central banks were not around then, including ours, which we only started operating in 2021. There were lessons from there, but not much for central banking coming out of that. What is in no doubt is that the current era had made the short-term trade-offs between inflation and growth much sharper, but more importantly, it also made the intertemporal trade-offs much sharper. What you can't do in making policy is to allow the excesses of today's generation to put a burden on the future generation. So there's got to be intergenerational equity. So as we respond to the inflation, and we say that if we allow inflation to be high, getting into the future, it might undermine future growth. If we do not act and it undermines future growth, indeed, you have just passed the problem to a future generation, which would actually be unfair. I hope that deals with your questions, TK. We can always continue them.
So thanks, Governor. To be fair to those joining us online, just really few questions, which I think you could take it in one. The first is a central bank backed digital currency. Where is our central bank in this? The second one is there a renewed role for the new development bank, given the crisis that's happening in the world today? The other is a cry that we are losing our homes due to high interest rates. How should we approach this? So we'll leave it at that, and then you can make your closing remarks, Governor.
Okay. Let's start with the central bank digital currency. Is the easier one. The question that we always ask ourselves as central bankers is a central bank digital currency a necessity, or is it a solution looking for a problem? And we decided that we are going to embark on a journey of learning. Money is a social good, and everyone should have access to it, of course, legitimately. Our baseline as the South African Reserve Bank is that if we end up with a central bank digital currency, it will exist alongside the existing currency. There are lots of things that you'd have to deal with. We ran an experiment on a wholesale basis of a central bank digital currency with a project that we called Project Coca. And we used the technology there. And then subsequently, we did another experiment with the Central Bank of the Singapore Monetary Authority. And instead of going on the journey on our own, we decided to join a community of central banks led by the Bank for International Settlements. So various parts of the world study different aspects of the central bank digital currency. For all intents and purposes, on a wholesale basis, we have this thing. So the big monies that move in South Africa, it's all moved digitally. But there are also important aspects about cross-border nature of a central bank digital currency. What are the legal issues and all of that? So it's a complex area that we are on a learning journey with the other central banks. And lastly is what would be the role of this central bank digital currency for the retail market? If it is digital, to be serious, what happens when there is load shedding? Right? And so one of the things then we are dealing with is that it needs to be possible for the digital currency to be available online and offline, so that if there is no electricity, you could still do trades in a CBDC. It's a complex area that we have been exploring. The
housing.
The housing, I want to finish with it.
It's the new development bank.
The new development bank was the next question. This is driven, the new development bank is driven by treasuries. The central banks have got, it's not a bank, but it's something, it's an arrangement. We call it the contingency reserve arrangement. And in the contingency reserve arrangement, the central banks pool a certain amount of their reserves, whereby if one of the countries in the BRICS would need access to foreign currency, it can access. And those currencies is the currencies of the BRICS countries. So that is what we have. And we run these simulations on a regular basis. And two of the most recent simulations couldn't take place. Why? Because Russia couldn't settle, because there are sanctions. So that is what we have. And the new development bank itself had found that it would be difficult for them to lend money into Russia now, because Russia is sanctioned. So these things have got to be located within that the global financial system. Last question with housing. I mean, let me first, before I get into housing itself, and say, we hear the cries of South Africans. When South Africans are complaining about the rising cost of living, we hear your cries. We hear your cries when you say that inflation is eroding your income, whether it is the income in the form of a salary or in the form of the 350 that you are getting from government or some other grant from government. Erosion of that income by inflation is what the central bank should deal with. We hear those cries. But in dealing with your cries, there is going to be short-term pain. And that short-term pain, unfortunately, comes in the form of the medication that is interest rates. It's not going to be easy. There are no easy answers here. And we do not derive joy from people losing their houses or losing their cars. We do not derive joy from that. But we understand that we have to do this thing. It will be painful in the short term because we have got to deal with this medium-term problem called inflation that is eroding the income of the South Africans. If we don't, we might end up in a different era. TK talked about the Volcker era. Let's talk about the South African era of 1998, when interest rates went to 25.5%. And South Africans were in all sorts of trouble. And we ended there because inflation expectations were not anchored and inflation was rising. And the central bank almost needed to demonstrate that it could do something about it. And it was also a very difficult era because during that era, we do not know what the focus of the central bank is. The central bank was trying to focus on what was called an eclectic monetary policy, trying to, one day they are worried about credit extension, one day they are worried about money supply, the next day they are worried about this. It was not clear what the anchor of monetary policy was. In 2000, the inflation targeting framework was introduced. Do yourself a favor and study the era of inflation targeting. This year, we are celebrating 21 years of inflation targeting. In that era, not last year, we celebrated 21 years of inflation targeting. In that era of inflation targeting, there is one common thing. Growth has been better. Might not be what the kind of growth we want, but it was definitely better than the previous eras. 2, inflation was lower. 3, interest rates were lower. And every epoch, every shock, we just come out, we have learned, we come out better. And so in 1998, interest rates peaked 25%. In 2009, interest rates peaked at 12.5%. In this era, they will peak lower.
I won't say where you were during that era, Governor. But we really out of time. Governor had pleaded earlier that he has another engagement in Johannesburg. Really want to thank you, Governor Kganyago. This was fantastic. It was comprehensive, highly engaging. Many people say you don't engage, you just lecture. I hope they will change their minds. It was really great. And also just to thank the audience and those who raised tough questions. As a university, we encourage robust debates, and we are going to bring you more of these. And also thanks to your team that worked so well with us, and thanks to Mane Eboikanyo, who's our marketing manager in the team she worked with, and also to thank the media contingent. We've come to the end of the discussion. Thank you.